Thank you, Martin. That was terrific. Hi, everyone. I'm Shana Oleshik, the Director of Banking Policy at Better Markets. We have an all-star cast for our first panel. It's going to explore what's changed or not changed from Bear Stearns and Lehman Brothers in 2008 to the collapse of Silicon Valley Bank and First Republic Bank in 2023. We are very fortunate to have Deborah Solomon as the moderator for this panel. She has had a long and storied career in journalism. Deborah has been the economics editor at the New York Times for more than 6 years now. Before that, she was a longtime award-winning economic policy reporter and news editor at the Wall Street Journal. She led the journal's coverage of Washington's response to the 2008 financial crisis and was a finalist, along with several colleagues, for the 2009 Pulitzer Prize. Her reporting focused on corporate misconduct, the 2008 crash, financial regulation, the SEC, and much more. Her full bio and all the participants' bios are on the Better Markets website. Deborah, over to you.
Thank you so much for that nice introduction. And I feel very privileged to be with this all-star cast. I wish we had all been together 15 years ago because it would have made my job easier. So I'll do a quick intro. I think Dennis Keller had mentioned who everybody is, but just to give a short introduction to our panel, we've got Bill Cohan, whom I'm sure many of you are familiar with. He was a longtime senior investment banker at some of the biggest banks on Wall Street, including Lazard, Merrill, JP Morgan. He's written several books, bestsellers, including House of Cards, which is about the downfall of Bear Stearns. He wrote a book about Goldman Sachs as well, and The Last Tycoons, which is the secret history of Lazard. A lot of you probably read him for a long time in Vanity Fair, but he has recently switched over to Puck, a digital news and opinion organization that he helps co-found, where he continues to write very lively pieces about Wall Street. So Bill will be joining us, as well as we have Jeremy Kress, who we're very privileged to have. He's an assistant professor of law at the University of Michigan, and he was at the Fed for a long time. He focuses on systemic risk. He knows everything about SIFIs and Basel, and can probably talk our ear off again about the Basel III endgame rules. So we're very privileged to have him as well. Frank Partnoy, who is now at University of Berkeley. Knew him for a long time at San Diego. He has obviously been very prolific in writing about Wall Street, and has authored dozens of pieces, maybe more than dozens, for some of the biggest publications. Has appeared on lots of shows, including 60 Minutes and Daily Show with Jon Stewart. I forget what it's called now because we've had so many hosts. And now we've got Jennifer Taub, who is probably one of the best known people for understanding the mortgage market meltdown in 2008. She's an advocate, and she focuses on explaining to people all the intricacies of Wall Street and why they matter, and how how to understand what's happening in the real world, and how it affects you. She's also very focused on white collar crime, and she wrote a book in 2020, which is about following the money. So I'm very proud to be on a panel with all of you. And I guess we're going to start with some 10-minute presentations from each of our panelists, and then we'll jump into questions. So Bill, I'm going to hand it off to you.
Well, thank you, Deborah, for the kind introduction, and thank you, Dennis, for having me, and thank you to Elizabeth Warren for that inspiring conversation, which reminds me we haven't come all that far in 15 years, and for Martin Wolf, just a master class. That was a stunning presentation that he gave us, and we were all privileged to hear that. In my 10 minutes, which are rapidly deteriorating, I just want to make the point, I think, that the system is designed and continues to be designed, the financial system, to allow for failures, to accept failures, bank failures, on a regular basis. In our history, of the country. I mean, essentially, we were born out of a financial crisis when we couldn't pay our debts for the Revolutionary War. And pretty much every 10 to 15 to 20 years since then, we've had a financial crisis. And I think that when you really step back from it and think about it, it's sort of the price we're willing to pay for the way we've constructed our financial system, which is really a fractional banking system, which means that we put money in banks. We think that our money is safe in the banks. We think that our money is at the bank when we want to get it out. And pretty much every time we want to go to the bank and get it out, it's there for us. It used to be we had to go to a teller and present various documents and stand and wait, and then the teller would hand us cash. Now, of course, as Paul Volcker once said about the ATM machine, it was the greatest innovation in banking in the 20th century. You go to the ATM machine, you put in a little card, and you put in your code, and out comes your cash. And so that's the way it works, and it works great until people panic and everybody wants their money at the same time. Or a lot of people want their money at the same time. Doesn't even have to be everybody. And when a lot of people want their money at the same time, as we saw with Bear Stearns in March of 2008, or Lehman in September of 2008, and it wasn't just those two. Of course, it was Merrill Lynch, it was Morgan Stanley, it was almost Goldman Sachs, it was AIG. It was, as I explore in my latest book about GE, it was GE Capital, which frankly nobody even paid attention to, even though GE was, one of our biggest and most powerful and important corporations. It was, and as we also know, we had a problem with the automobile companies. And of course, then the same thing happened earlier this year with Silicon Valley Bank, with First Republic Bank, and with Signature Bank, as Senator Warren was talking about. And the reason that that bank panics result in financial crises is because in a fractional banking system, which is how we've designed our banking system and how it remains designed despite Dodd-Frank, despite re-regulation, despite the regulations that were put in the Great Depression. In a fractional banking system, the way banks make money is that our money isn't at the bank. It's never been at the bank. And in fact, if the money were at the bank, banks couldn't make money because they take our money and then they lend it out. They take our money and reward us with, at the moment, tiny amounts of interest payment. And if I look at my checking account and my savings account, which are at JP Morgan Chase, our biggest bank, I get 1 basis point of interest on my checking account and a whopping 2 basis points of interest on my savings account, which means essentially that, number one, JP Morgan Chase doesn't really want my deposits anymore, because if they did, they'd pay me more for them. Okay, that doesn't mean anything. They still have 2 trillion plus, 2.5 trillion plus of deposits. They're viewed as particularly, one of our safest banks. And they essentially get their raw material for free. Their raw material that they use to make money is our deposits. And they're basically paying us nothing for them. They then turn around and lend that money out to corporations, to endowments, to universities, municipalities, individuals, and they capture the spread along with a bunch of fees. And that's essentially one of the main ways banks make money. So we put our money in, we get a tiny amount of interest from it, at least at the moment, and we think that the money is there, but of course it's not there. And everything about a bank is designed to maintain that fiction that our money is safe. Like when you go into a bank or at least in the old days, there were barrel vaulted ceilings in these big branches that looked so elegant and lovely. And in the corner, you could spy a huge bank vault, which was just opened a little bit to make you think that your money was tucked away in there, and that if anybody ever got close, that bank vault that bank vault would shutter, and your money would be safe. But of course, that is all just a major league fiction. It's all designed to create what is essentially a confidence game in our banking system. And once people lose confidence, like they did in March of 2008, when Bear Stearns went down in a week, or with Silicon Valley Bank 15 years later, when literally, in 36 hours, people through their iPhones were able to whisk away their deposits out of the company, then the bank, then banks fail because by design, banks are in the business of borrowing short and lending long. And that works fine until people lose confidence in that system and want their money out. They wanted their money out at Silicon Valley Bank. They took it out in 36 hours. Those are short-term liabilities that can leave. Deposits are nothing more than short-term liabilities that can leave the bank in an instant, as we found out earlier this year, leaving long-term assets, these loans of 5 to 7 to 10 years, or in the case of Silicon Valley Bank, they were long-dated treasury securities that they thought were safe. And what eventually happens is that when you're in the business of lending long, of borrowing short and lending long, you have created an extremely risky financial system. And what people forget is that Wall Street has always been a very risky place. We're lulled into complacency because the risks don't show up except for, once every 10 to 15 to 20 years. And then we have to deal with it. And, as we see over and over again, especially lately, that dealing with it means that the Federal Reserve, the Treasury, the Congress has to come forth and put forth these huge bailout plans. And so the system is designed to fail. And once every 15 or 20 years, it does fail. And we forget that. And I'll end by just telling people, about my experience. More than 17 years working on Wall Street. I was an M&A banker at Lazard, Merrill Lynch, and JP Morgan Chase. I had no idea how any of these firms finance themselves. That wasn't my job. My job was to bring in M&A deals, do M&A deals, get fees for M&A deals. I hadn't a clue about how these banks finance themselves or how risky they actually were. And that's the way everybody is who works on Wall Street. There's a very tiny percentage of people who work at banks who really understand how risky they are. Where our rewards were to bring in fees. And if we did that, we got rewarded with big bonuses. And people are pretty simple. They do what they're rewarded to do. And on Wall Street, they're rewarded to bring in fees on a daily basis. They are not rewarded to figure out the risks that exist in the financial system or at their individual bank. Thank you. I look forward to working with the rest of the panel and having this robust discussion.
Thanks, Jeremy.
Thanks, Deborah, and thank you to Better Markets for the opportunity to be here. I'm deeply grateful for all the wonderful work Better Markets does advocating for appropriate oversight of the financial sector, and especially grateful to Dennis for his idea to host this event today to commemorate an anniversary that I worry would have gone overlooked, but for the conversations that we're having today. So I'm excited to be here. In keeping with the theme of the panel, I'm going to gear my remarks toward what has changed since Lehman and Bear Stearns, and also what has not changed, or perhaps what has gotten worse since Lehman and Bear Stearns. And in keeping with my expertise, I'll gear my remarks toward the regulatory environment in which financial institutions operate. So in terms of what's changed, I think on a positive note, we can be confident that the financial system is safer and fairer today than it was in 2008, in large part due to advancements made by Dodd-Frank and Basel III. With no claims toward comprehensiveness, I will identify just 4 ways in which I think the regulatory environment has improved. First, bank capital requirements today are meaningfully higher than they were in 2007, 2008. The quality of that capital is higher. So when banks suffer losses, we can be more confident that their equity buffers are there to sustain those losses. By most estimates, the quantity of capital that big banks like JP Morgan and Citi are holding is roughly 2 times the amount of capital that they were maintaining pre-crisis. So strong advancements in terms of bank capital. Second, stress tests. The Fed now has a reasonably robust system for evaluating how large banks would perform under severely adverse financial conditions, and it can adjust banks' capital buffers accordingly. Third, we have other enhanced prudential standards like liquidity requirements, long-term debt requirements, resolution planning or living wills. All of these enhanced prudential standards are supposed to make bank failures more manageable, give regulators more time to assess and plan for how to handle a bank failure should one occur. And fourth and finally, perhaps one of the most meaningful advancements in the last 15 years was the establishment of the Consumer Financial Protection Bureau. We now have the CFPB as a dedicated consumer finance regulator to prevent both banks and non-banks from exploiting consumers like they did pre-crisis, when consumer protection was fragmented and ignored by all the prudential regulators. So these are some, I think, very important improvements. That's not to suggest that they're perfect. I think each of the 4 areas that I mentioned could all be improved upon, but they're all really significant ways in which we live in a different world today than we did in 2008. Importantly, I want to point out one common theme with each of the 4 areas that I just mentioned, and that is all of these advancements are currently under attack by the financial sector and their allies. If the banks get their way, we could see the progress of the past 15 years erased and reversed. With bank capital, we're seeing the financial sector putting a whole lot of money and lobbying power behind their Stop Basel Endgame campaign to prevent the financial regulators from instituting enhancements to the capital regime. On stress testing, we're seeing the banks gear up to judicially challenge stress tests as some sort of violation of the Administrative Procedure Act. We're seeing banks gear up for a potential legal challenge to the enhanced prudential standards as they apply to $100 billion to $250 billion banks. They view this as a violation of the tailoring law that was passed in 2008, also known as the Dodd-Frank rollback bill. And just next month, on October 3rd, the CFPB is going to the Supreme Court to defend its very existence against a radical legal challenge to its funding mechanism. So while we have made really important improvements, it is critical that we not rest on our laurels, because even the improvements that we've made today, 15 years later, are still under attack, and we're at risk of backsliding if the industry gets its way. So that's what's changed. Let me talk for a few moments about what has not changed, or perhaps what has gotten worse. I don't want to dwell too much on the negatives, but we need some continued improvement in areas that we've not gotten our arms around since 2008. Let me identify 3 areas. First, building on Bill's comments, non-bank systemic risk. We have gotten nowhere on systemic risk arising from investment banks, insurance companies, other non-banks, money market mutual funds. We often think of the 2008 crisis as a non-bank crisis triggered by Bear Stearns, Lehman Brothers, AIG, Morgan Stanley, Goldman Sachs. And yet here we are 15 years later, and we've done nothing to better regulate non-banks. Dodd-Frank did set up the Financial Stability Oversight Council, and FSOC appropriately designated for companies, AIG, MetLife, Prudential, and GE Capital. That did some good things. GE Capital and AIG simplified themselves, reduced their systemic footprints in order to win de-designation, but then we saw MetLife challenge its designation in court, and we had a very wrongly decided district court case in MetLife that released MetLife from its designation, and unfortunately has laid the groundwork for the industry to target FSOC in general. The Biden administration appropriately is trying to reinvigorate FSOC, but there is still so much work that needs to be done on non-bank systemic risk. And critically, this non-bank problem has gotten worse because we've seen an increasing proportion of financial activity migrate out of the banking system and to non-banks. So that remains a very significant vulnerability that we need to do a lot more thinking about. Second area that has not changed or gotten worse is concentration. The 2008 financial crisis was perhaps caused by, at least exacerbated by, very large, very powerful financial institutions. And yet here we are 15 years later with even larger and even more powerful financial institutions. JP Morgan, Bank of America, Wells Fargo, they're all 2 times the size today as they were before 2008, even after adjusting for inflation. And the number of community banks in the United States has declined from 8,400 in 2008 to 4,400 today. So we're seeing increasing concentration. That concentration has harmful consequences on a number of dimensions, including reducing competition, increasing financial stability risks, and posing a threat to democracy itself through the intense concentration of financial power. Third and final area that hasn't changed or has gotten worse, and related to the second, the too big to fail and too big to manage problems. Too big to fail, too big to manage. I know I'm previewing here a panel that will happen this afternoon, but in my view, they are both alive and well. On the too big to fail front, you need to look no further than Credit Suisse, which just a few months ago demonstrated that we have more work to do to ensure that mega banks can be wound down safely and without government assistance. And as Silicon Valley and Signature demonstrated in the US, we need to expand our understanding of what we think of as too big to fail. It used to be that we just thought of the G-SIBs, the 8 global systemically important banks. But we are now appreciating that we have a category of domestic systemically important banks that are sometimes erroneously termed regional banks, but we are finding out that they are in fact systemically important. So that's too big to fail. Too big to manage remains problematic. Wells Fargo has now been subject to its asset cap for 6 years. Wells Fargo is not the only problem. According to the Federal Reserve Supervision and Regulation Report, exactly half of the large banking organizations with more than $100 billion in assets today are rated to be in not satisfactory supervisory condition. So we still have a too big to manage problem, and yet so far we've been unwilling to impose meaningful consequences to get that problem under control. So thank you for the opportunity to present these remarks. I look forward to hearing from Jen and Frank, and then having a discussion and debate afterwards.
Thanks, Jeremy. Frank?
Thanks so much. And special thanks to Dennis and Better Markets, not only for organizing today, but for their role commenting on various regulations over the last decade or so. And I also want to just call out Stephen Hall as being an especially astute commentator who I've worked with, particularly over the last year and a half. I set up a nonprofit, co-founded the International Institute of Law and Finance, and we've worked with Better Markets, and we don't always agree, but we always know that we're going to get an open, interesting, well thought out perspective. And already I'm excited about today's comments because they're similar to what Better Markets has been doing over the last 15 years. And so when Dennis asked me to do this, and I thought on questions since Lehman and what's changed and what's not changed, I immediately thought of some big picture issues. And so what I'd like to do is talk about some big picture macro bank incentive failure questions that I think in many ways have gotten worse since Lehman. And then give a little bit of a California perspective. I teach at UC Berkeley, and in many ways, this recent banking crisis had a California flavor to it. And then talk a little bit about how some of the market actors and market institutions have changed and also in many ways are failing us. So first, with respect to the big picture questions, the way that regulators and academics have long thought about bank failures is to think about market failures and the ways in which markets don't adequately incentivize large financial institutions. And the three buckets that economists and legal academics often think about are moral hazard, taking on increased risk in the presence of insurance, information asymmetry, gaps between people within these institutions and people outside of them, and agency costs, the costs within institutions and within regulators in terms of the people at the top and the people at the bottom. And certainly with respect to moral hazard, there have been significant changes in the last 15 years. And we don't know the counterfactual of what would have happened if we hadn't provided floor support for financial institutions recently. We can't run the counterfactual, but we do know that what counts as systemic risk is much broader now than it was 15 years ago. So 13.3, which is the portion of the Federal Reserve Act that permits emergency lending, is now the standard toolkit post-Lehman. It was the toolkit in the aftermath of the financial crisis. It was the toolkit in March of 2020 when many people thought the financial system would collapse. And the systemic risk exception was a significant part of the toolkit on March 10th in response to the collapse of SVB and the instrument for regulators to make depositors whole right away. And we got a bank term funding program and a $25 billion backstop very quickly because regulators determined that there was this emergency, that there were unusual and exigent circumstances that existed at the time that warranted the approval of this. And I think most people would agree that the assumption that 13.3 facilities are part of the standard toolkit is something we didn't think about when Lehman collapsed, and that this exception and the idea of what systemic risk is much, much broader than it was 15 years ago. I think in terms of big picture macro issues, that this information asymmetry idea also has changed a bit. The idea that we can look inside an institution and understand its assets, liabilities, and risk. In some ways, it's gotten better. We forget the Lehman collapse was followed by an extensive investigation, and many of us read the 2,000+ page report in bankruptcy that included morsels like Repo 105 and the misrepresentation of values and moving risks off balance sheet. And back then we thought we might actually fix this. And I think one of the biggest changes since then is that we've essentially given up on the kind of granularity and disclosures about assets and liabilities and risk. At least back then we looked at things like collateralized debt obligations and tried to figure out details. Now, I'm not sure all that many people are looking carefully at bank financial statements. And I'll just say, I think the SEC has done a tremendous job here. And I think Chair Gensler and the head of the Division of Corporation Finance, Eric Girding, deserve a lot of credit for ensuring that we have adequate disclosures. And we had a lot of information about SVB and others well before this crisis. But the problem is a lot of people are not paying attention to it. And this relates to the moral hazard problem. You don't necessarily pay attention to the details if you know that the financial institution will be backed by a 13(3) facility if things go south. So I think a lot of the information that was of concern for SVB actually was disclosed. I am worried, just to not paint too glossy a picture here, that there are a lot of risks. And again, this information asymmetry has gotten a lot worse at the larger financial institutions. And I'll just mention collateralized loan obligations and leveraged loans, which were part of the March 20 backstop. And now we have not only the proliferation of these loans, many of which are not mark to market at financial institutions, but we have ETFs based on CLOs. We have expanded risk taking related to leveraged loans. So some worries that have gotten worse, some are not so much, not as bad. And then the third category of agency costs is one legal academics always think about these kinds of concerns about monitoring and costs and risks within an institution. And as Jeremy says, these banks are much larger now. There have been a lot of improvements in terms of taking proprietary risk, but there still are rogue areas within financial institutions. And because they're much larger, what counts as material and therefore needs to be disclosed is also much larger. And so a lot of people worry about significant risks in areas within large financial institutions that we don't even find out about, that we won't ever find out about because they're not deemed material. So those big pictures are really the main thing I wanted to say. I'll just spend a couple of minutes talking about the California vibe to SVB. I'm vegan. I was trying to think of a good food analogy for this. I don't know where I would put the avocados or the sprouts, but I will certainly say that the menu of who the depositors were at SVB was very, very different. And the flavor of the collapse for people who were in the Bay Area is very different. The point that Bill made about the speed at which people withdrew was just breathtaking on March 9th with $40+ billion of withdrawals in one day. And what's interesting, I think, and quite different, is that the largest depositors were new names. And we know who those people are. And what's interesting is that the same sort of emergency facilities and concerns were about institutions who were depositors like Circle Internet Financial Limited, the largest depositor at SVB, Sequoia with $1 billion of deposits, and many startup companies, relatively young companies, Altos Labs, a private life science startup backed by Jeff Bezos, which had almost $700 million worth of deposits. And I think one of the things that we should think about when we think about SVB and First Republic is just the fact that the context is quite different, that the breadth, it's not a New York kind of focused, it's not really even international in the same way. And again, many people were aware of this. It's not like this was a secret at the time. The closing issue I'll just spend a minute on is about, it's not just about regulation and supervision from the government. 15 years ago, it was conceivable that a Lehman could fail, and people in the market, private actors, actually looked for Lehmans. They investigated. And there were 4 categories of groups in particular that have, I think, been gutted in the last 15 years that used to spend a fair amount of time and have market power. And those are journalists, short sellers, plaintiffs' lawyers, and shareholder activists. And all of those categories, these are people who used to spend a lot of time looking at these issues. Jesse Eisinger, the Pulitzer winner for reporting on the crisis, and I did a 9,000-word Atlantic cover piece more than a decade ago now, basically saying that banks are like paintings and that people in the markets can't understand them, and people aren't even looking at the details about disclosures. And if we look at the significant market actors who back then would have spent the time, people like Bill Ackman, for example, who looked in detail at CDOs and NBIA and had a massive spreadsheet that caused my computer to crash when I used it back 15 years ago, aren't bothering to look at financial institutions. And it's become very difficult to wade through Bank 10K. My favorite is Wells Fargo. I keep looking at them and keeping an eye on them. But my closing thought for all of you would be, if you haven't read a Bank 10K recently, it's worth a read. Just after our panel or after today's remarks, just peruse a Bank 10K and tell me you aren't worried about large financial institutions.
Thanks, Frank. Jennifer?
Thanks so much, Deborah, and thank you to Dennis, the whole team here at Better Markets, for everything you've done up until now and helping us remember these events from 15 years ago. And I'm honored to be on this panel with all of you. I've read your work and I learned so much from you. One thing I'd like to add about my background is before I joined academia, back in 2004, I had worked as the head lawyer for fixed income at Fidelity Investments. And so I was right there, near the repo desk and actually knew what short-term wholesale funding was as the lifeblood of the financial system well before I completely panicked in September of 2008 when I heard, that the overnight funding markets were freezing up. Something obviously separate and apart from the $700 billion TARP that was being negotiated, and it made me panic. I will get to that in a moment, but first I want to comment and build on in my remarks what my fellow panelists said. And I'm going to start with something that Bill said that I think is inherent in everything we talk about, which is the fundamental fragility of fractional reserve banking with maturity transformation. And that's how we talk. But what we're saying is, when deposits can be withdrawn quickly, and whether those are your or mine, retail deposits or brokered deposits, big chunks of uninsured deposits, such as in Silicon Valley Bank or during the S&L crisis, or repo funding, as was in the case, in 2008, when the money funding banking institutions can leave more quickly than the assets backing that funding can, because these are longer term loans or, hard to value illiquid securities. When that happens, and it does happen because that's inherently the nature of banking, there are going to be bank collapses. And the question is, what was the promise made to us after the collapse of 2008, and why are we still facing similar risks today? And I'm going to talk abstractly and then look at some numbers. And specifically, there's this quote I go back to from Fed Reserve Chairman Ben Bernanke from 2009. And he said, it wasn't to help the big firms that we intervened. Those companies have turned out to be too big to allow to collapse, because when the elephant falls down, all the grass gets crushed as well. And then he said, we really need a new regulatory framework that will make sure that we do not have this problem in the future. Okay, so if you unpack that metaphor, I see a number of things that are in that promise. It's a promise of prevention, that somehow the steps will be put in place, whether it's the regulators or, in the case, one would hope, as I think as Frank just mentioned, that the shorts, or there'll be some sort of self-regulatory mechanism on Wall Street, but really that we put something in place where regulators would have more power to prevent these collapses. And some of that could be by either downsizing banks in theory, or making sure that they didn't have as much of the economy in terms of GDP, or they weren't as highly leveraged, that they didn't borrow more to finance their balance sheets, that they were funded more with equity, for example. There are all kinds of ways of talking about prevention. Also limiting how much they can take depositors, insured deposits and other deposits, and invest them in high risk investments, including complex derivatives. All that stuff is about prevention. The next piece, of course, besides prevention, is the idea of intervention. The need to, because these were the debates, 13.3 was there to rescue Stearns, but then not, that no one wanted to, that we, let Lehman fail. And so there was this argument that we needed better intervention tools. Then there's also, of course, the making people whole. It's sort of part of intervention. It's something we really did a terrible job of after 2008 in terms of underwater homeowners and letting millions of families lose their home. I think we've gotten better at intervention, as we saw with the COVID crisis, what we did to put money in the system, even directly having, mortgage firms not foreclose on people. There's a lot that we did, so we didn't have a catastrophic failure then. But one of the areas, and I would argue, the last area, and then I'll kind of go through each of these, the last area of concern is accountability. And this is where we have utterly failed. And, in every way that you can think about, there are you look at the major bankers who were involved in the financial collapse, and you could say, well, I'm sure if there were crimes, someone would have prosecuted them. I'm not so sure. And I don't want to cross over into defamation, but I will note that there were several senior bankers who ended up in settlements with regulatory agencies related to fraudulent things they said and did, but somehow those weren't made as criminal cases. Other countries managed to do it. We didn't. Only one sort of senior level banker that Jesse Eisinger wrote about did get prosecuted. So there's a huge problem there. It's perverse incentives because, at the end of the day, to quote one of my favorite television series, Succession, if it's just a number that the corporation isn't going to pay, and there's not going to be a senior executive or even a sacrificial lamb to go to prison, there's not a lot of incentive for these banks to change their behavior. I will also then, and I've only got a few minutes left, talk about the prevention tools. What was going on at Silicon Valley Bank that the San Francisco Fed, did not notice that their balance sheet did not look good in terms of, you may say, oh, well, it looked healthy in terms of just the numbers, in terms of a capital cushion. But in reality, when you're depending that much on such big amounts of uninsured deposits, I'm not sure why they were allowed to grow so quickly, so fast. And it's not just because of the things that we warned about, the 2018 rollback in terms of in terms of supervision. There could have still been supervision on this institution as it grew. In terms of the tools for prevention, Jeremy mentioned this in terms of the size of the banks, and this is something I had looked at previously. You can look at the raw balance sheet numbers, and you can also look at the top U.S. bank holding companies relative to GDP. In 1995, it was around under 20%, around 15%. In 2005, it was 50%, and up in 2013. 10 years ago, it was up to 60%. So I looked at those numbers now, and I went back and looked at 2018 and then today. And in 2018, the top 6 banking firms, which have had 10.5 trillion collectively on their balance sheet, that represented 51% of GDP then. And then right now, as of spring, the number is $14 trillion total for those top 6 bank holding companies, and it's back up to 55% of GDP, which is over, it's a little lower, as you can see, than it was in 2013, but it's still well above the 2005 amounts. I'm going to jump over leverage for a moment and talk about repo funding. This is another area of concern. Tri-party repo alone in 2008 was like $2.7 trillion. It started creeping back up when I had looked at it recently. I just took a look yesterday, and the numbers are tremendous. Total outstanding tri-party repo is like $4.7 trillion. Now, you may say, well, that what is the concern there? It's obviously, to the extent that we're talking about repos relied upon by the investment banks to finance their balance sheet, runs are the concern. On the other hand, for folks who are following this, maybe some of this isn't so concerning because money market funds can now go to the Fed as lender of first resort with their extra cash. So you really have to you really got to get into the weeds of this. But I will tell you, I have not seen a lot of people focused on this, despite the fact that there was a huge bailout in 2019 of the repo market. And so, I unfortunately have turned my eye away from some of the short-term wholesale funding issues because I've been focused almost exclusively, as Deborah has noted, on white-collar crime. So I'm glad to be back in the mix here, and maybe I will turn my attention to repo with a laser eye. So thanks all.
Thanks so much for that and for all the panelists. That was really interesting. Listening to what folks have said, it just really, one of the things that strikes me is just what hasn't changed and where we are now versus where we were 15 years ago when we had the regional bank runs and the failures, the government swooped in and basically made the depositors whole, and there was barely a peep about it. There was not the kind of outrage that you saw in 2008. I mean, granted, the economic consequences of it were not probably as severe. There was a lot more going on. People were, being foreclosed on. So the human costs in 2008 were much more pronounced. But my question is, to Bill's point, he said the system is designed to accept bank failures on a regular basis. It seems almost like we've internalized moral hazard, that we just accept that this will happen every 15 or 10 or 25 years, and the government will come in and do what it needs to do, which is rescue the depositors, rescue the bank itself, figure out some way to get the bank to prevent its collapse. Dodd-Frank was supposed to prevent that from happening. So I guess my question is, are we basically just living in a world where we have a de facto government guarantee of the banking system? And does that matter? Jennifer, let me start with you since you were on my screen in front of me right now.
There's two questions. Do we have a de facto guarantee, and does it matter? Yes and yes. But I think the reason why people weren't up in arms, in addition to what you mentioned, which is they weren't being kicked out of their own homes, and they weren't losing their jobs, so it's sort of hard to sort of piece together. Part of it is because even though I was unhappy that the government went in and made the uninsured depositors whole, they actually did contain the spread of this. And so this is, the question we have to ask is, given the system we have where these entities are actually too big to manage and too big to fail, what else do we want our regulators to do? I think I want accountability. At least the boards of these enterprises shouldn't be there, and then we should downsize them. The answer shouldn't be let's let the whole thing fall apart and people be out on the streets and the financial system, collapse again, and then have it, as Martin Wolf mentioned, be an opportunity to feed and the rise of authoritarian leaders. No, that can't be the answer. We need to downsize these institutions and make them more stable. And I think the second piece of it, I think the other reason why people aren't paying so much attention is look around. Look at what else is going on. The country is in the middle of an existential crisis related to the survival of our democracy. I know that that's sort of like in the wings, but that's a backdrop here. And we had the COVID crisis. So I think what would have bothered us, now just seems sort of like a rounding error at this point.
Bill, what's your thought, given you're the one who kind of talked about how this is how the system is designed and it's rigged this way? Do we basically have any choice but to have a system like this?
Deborah, what choice is there really? It's either, save the bank or bail out the bank, bail out the depositors, bail out the creditors, give a tip to shareholders, as happened, say, with Credit Suisse, or face existential crisis. Because when a bank collapses, there's detritus strewn all across the landscape, from people losing their homes to people losing their companies to people losing their cars, things that we literally take for granted. So it's quite binary, it turns out. Until Bear Stearns was bailed out in 2008, the federal government had never bailed out an investment bank before. Investment banks were deemed to be risky, non-depository institutions, and therefore, if they failed, so be it. But once upon a time, they were also small private partnerships. and there wasn't systemic risk attached to the failure of an investment bank. But that began to change in 1970 when DLJ went public against the wishes of the New York Stock Exchange until they changed their rules. And one firm after another became a public company, got really big, used other people's money, made acquisitions, as Elizabeth Warren was talking about. So now these firms, of course, are SIFIs, systemically important financial institutions. We can't risk them going down the tubes and causing the existential crisis that would inevitably result. What I'm just riveted by is, where was the San Francisco Fed on Silicon Valley Bank situation? I mean, obviously, their liabilities were short and they were lending long, even if they were investing in long-dated treasuries that they thought were safe. But how could, a bank regulator, let alone the CEO of that bank, not be painfully aware of the risk, the huge risk that would have resulted from rising interest rates if you've got a portfolio of treasury securities that were bought at high prices and low yields? It was obvious that the zero interest rate program, quantitative easing, was going to end after 13 years. I mean, you didn't know exactly when, but it was obvious that this had to end, that you could no longer manipulate interest rates down to zero ad infinitum as much as the market wanted that to happen. How could you be, a highly compensated CEO executive, a CEO of a bank, and not understand that risk was looming out there? How could the regulators at the San Francisco Fed not realize that risk was out there? So part of it is the way the system is designed to make these blowups inevitable. And part of it is bank CEO management risk failure and supervisory failure. And, when you have all those things together, you get the blowups.
Well, I guess I want to talk about that for a minute. It's interesting to me that people always talk about where were the regulators? Okay, so I want to read two quotes. One is from Ben Bernanke in May of 2009. He said, the events of the past 2 years have revealed weaknesses in both private sector risk management and in the public sector's oversight of the financial system. It's imperative that we apply the lessons of this experience to strengthen our regulatory system, both at the level of its overall architecture and its daily execution. So then we have from the Barr report, regulatory standards for SVB were too low. Supervision of SVB did not work with sufficient force and urgency. Following SVB's failure, we must strengthen the Federal Reserve's supervision and regulation based on what we have learned. Jeremy, are we actually able to regulate for problems, or do we always just chase the last problem and take our eye off the ball for what might happen next? I mean, to Bill's point, it was in plain sight that interest rates were going up and that if you were betting against them, you were going to have a problem. There obviously, the report pointed out that there were concerns about by the regulators, and they didn't necessarily feel emboldened to raise things. And I want to get to the whole rollback and the Randy Quarles piece of this. But Jeremy, I'm just curious, since you have spent so long looking at regulation and regulators, can we regulate the banking system at this point in an effective way?
Yeah, it's a great question, Deborah. And I think the Bernanke quote that you raised in the Barr report also appropriately balanced regulation on the one hand with supervision on the other. Regulation, just by its very nature and the requirements to go through APA, notice and comment, will in some cases be a blunt instrument that is not very dynamic. And that's why it's important that regulation be complemented by supervision, because supervision is the mechanism by which boots on the ground can go in and adapt to evolving circumstances and work with management to address emerging risks. So regulation, as you noted, very often has a tendency to fight the last war. I think good through the cycle, appropriate regulation can minimize a lot of risks out of the system, but there's always going to be residual risks that fall through the cracks of regulation. That's part of the job of a financial institution, is to optimize performance under legal constraints. And so agencies have to have effective supervision in order to respond to those residual risks that regulation simply isn't able to catch. As you noted, there's been some hollowing out of both regulation and supervision over the last 6 years that undoubtedly contributed to the SVB collapse. I'm happy to get into specifics, but I think just to emphasize the point, we've got to have both effective regulation and supervision. Neither one alone will be able to keep the financial system safe.
Frank, do you have any thoughts on kind of the ability of regulators and supervisors to prevent these types of crises?
Yeah, I think there's, from the supervisory standpoint, one of the challenges that we saw with SVB was that the supervisors really had their legs taken out from under them. Given the power dynamics of how finance and supervision works, bank management has sometimes been able to railroad supervisors when supervisors raise red flags. Supervisors have to have support from their principals, who are presidentially appointed, Senate confirmed. And when they don't have that support, it's way too easy for banks, executives, board members to ignore feedback that they receive from their supervisors. So I think we saw that supervisors at SVB did flag interest rate risk, perhaps not as early as you might have hoped, but certainly in enough time to do something to address interest rate risk. But for whatever reason, SVB management was not responsive to those concerns. And I think that has something to do with tone at the top with the supervisory agencies. So it's got to be a consistent message from supervisors on the ground all the way up to their bosses. And I fear that wasn't the case in the years leading up to the March 2023 crisis.
Frank, do you have thoughts on
Yes, Deborah, I think you've hit on a fundamental question about the temporal aspects of regulation and banking. And in many ways, the problem is always going to be looking in the rearview mirror, but it doesn't have to be, right? We can think about regulation of financial institutions in a predictive way. And this is kind of the way that we've moved towards a regulatory state and away from kind of common law approach, generally speaking, in the markets is part of this as well. We have a massive regulatory approach, but we don't have to. And part of the Volcker Rule and many criminal law concepts are tied to the Oliver Wendell Holmes notion. You probably didn't think Oliver Wendell Holmes would get presence in this panel, but his notion of the law being a prediction of what a judge will do. And I think one of the challenges is to get inside the minds of people at large financial institutions and have them start thinking about consequences as predictive. So the mismatch that Bill points to that is endemic between assets and liabilities is something that I think many people were aware of. They were aware of it in the context of bailouts and the likelihood of a 13-3 facility looming if it turns out that they bet wrong. But the way that Jennifer is talking about regulation and enforcement, I think, is something that hasn't made its way into financial institutions. Again, thinking about consequences in a predictive way and trying to imagine, okay, if I do this, what will be the consequences in a year or 5 years or 10 years? And it's rational, I think, for the managers of financial institutions who know that they have a mismatch between assets and liabilities to take a big yield curve trade. I mean, I was at Morgan Stanley in the 1990s when something similar happened with an increase in interest rates in 94, and people were well aware of the again, predictive aspects of taking on these risks at some institutions, but not at others. And so I think what you've pointed to is one of the challenges of both regulation and supervision, which is trying to force inside the minds of people at the institutions the idea that there will be future consequences.
Right. And we saw obviously a big change in 2018 with the law that passed through Congress that was supposed to be this tailored approach, remove some of the Dodd-Frank rules for smaller and medium-sized banks. It was, there were some obviously like Senator Warren who opposed it, but others were more, okay with it. Even Dan Tarullo, had said that he thought some of it was appropriate. In hindsight, we now see that it wasn't just that law, but the interpretation of that law by the Fed that helped fuel some of what happened at SVB. Now, there's lots of reasons, but if you read the report, the internal report, it's clear that the change in how SVB was treated once they crossed that $100 billion threshold was significant, because of the changes that then Vice Chair for Supervision Randy Quarles put in place. They crossed that $100 billion threshold, which was supposed to subject them to more liquidity and regulatory requirements in 2021, but they weren't going to be subjected to those higher capital or liquidity requirements or oversight requirements till 2024. And there was also a culture of feeling that, supervisors were supposed to be a little bit, nice to the banks, a big change from, in post 2008 when the banks were, what did Obama say? The only person between me and the pitchforks. He's the only person between the banks and the pitchforks. My question, I do have one, is how much do you guys think that the Fed's interpretation of what Congress approved in S1255, destabilized the banking system and undermined Dodd-Frank and sort of the idea of Dodd-Frank, if not for the biggest banking organizations, just for the overall banking sector? Jeremy, do you want to talk about that? I know you've got to leave soon, so I want to get your thoughts.
I would love to talk about that, Deborah. Thank you for the question. I will say, you characterized it as the Fed's interpretation of the law, but it is abundantly clear that that was the message that Congress was sending by passing 2155. Although Congress ostensibly left the Fed some discretion to apply enhanced prudential standards to banks with between $100 billion and $250 billion in assets, it is abundantly clear that every member who voted for that law expected the Fed to raise the threshold to 250. And if the Fed had tried to exercise that discretion pre-SVB, there would have been very strong congressional pushback to regulating the mid-size regional banks. The underlying assumption behind S2155 and the tailoring law was that banks in that $100 billion to $250 billion range are not and cannot be systemic. We now know that is, some of us knew then, everyone knows now that is now false. Banks in that range are systemic and should be regulated appropriately. I think, sometimes we can get in debates where we're fixated on unique issues having to do with SVB or unique issues having to do with First Republic, and the industry wants to argue about, SVB was unique because it had a high concentration of uninsured depositors, what have you. I think it's critical for the other side of the debate to point out that, yes, we saw 3 failures in SVB, First Republic, and Signature, but if it were not for the systemic risk exception that the FDIC invoked with the Fed and the Treasury, and very high-ranking government officials advertising that we stand ready to support other regional banks in similar ways, we very likely would have seen additional failures. So with the 3 banks that did fail, that constituted roughly 1/7 or 1/8 of the regional bank population. But absent government support, a much larger portion of that segment of the banking sector would have experienced continued stress. So I think the verdict on S2155 is it was wrong from the start, and the Fed can and should exercise its discretion to re-regulate that important segment of the banking system.
Jennifer or Frank or Bill, do you have thoughts on that as well? 21 on the how much the tailoring, dismantled a key part of Dodd-Frank? If not, I will.
Why don't you go first, and then I'll go.
Yeah, I mean, I'm one of those people who wrote one of these. I wrote a piece. I think it was might have been for Washington Monthly, or maybe it was, I can't remember where. And it was one of these. I can't believe I'm writing this thing, so later I can point back and say I told you so. But that doesn't feel very good. To me, it was clear that it was a mistake to do this. Having written the book that Dennis mentioned, Other People's Houses, was a comparison of the collapse during the savings and loan debacle to the 2008 crisis. And this idea that you have to say either or, that either it's just a problem of size, or it's a problem of types of balance sheets and interconnectedness. No, it's all of the above. And so I do find it frustrating that that's where things have gone. As to the distinction that you're drawing, Deborah, between how the Fed may have interpreted the legislation versus what it said. I've never worked inside the Fed, but in terms of regulatory capture, there's no question that if you spend your time working around people, you start to sympathize with them. And if you don't look like you're going to be understanding of a situation, then people won't speak to you. I mean, I just have to say that when I think about all of this, I think, again, going back to Succession, about how Shiv, the character on the show, said to someone that it's really just, agree that it's really all just money and gossip. And by gossip, she means the kind of spin and the kind of interpersonal relationships. And that's a lot of the reasons why we can't get change in Congress to actually permanently fix the system so that we have better prevention and reduce the numbers of these interventions, is because of all these factors: money and the political process, and the spin, and the way you have to appeal to folks in the financial sector in order to even have a chance at getting elected in many areas.
I have a couple of points, two points related to what Jennifer's talking about, which I think is really important. One is that the line drawing exercise that we're talking about, that we'd like for regulation to do and for regulators to do, is a really difficult one that we're likely to get wrong, especially if we use dollar numbers. If we go back to Lehman and we think about the granularity of the different banks and non-banks, they were very different. If everyone had the same risk exposure as Goldman Sachs, we wouldn't have had a financial crisis. If everyone had the financial exposure of Citigroup, it would have happened 6 months earlier. In terms of painting all of the relatively smaller banks with the same brush now, more recently, I think it's right that we separate them into categories by using these kinds of thresholds, but I'm just not sure it's such a good idea. And the second point is, I think with respect to using systemic risk, it's just too tempting. Once it's in regulation, regulators are embracing the idea that they can make a determination of the presence of systemic risk in order to trigger a rescue or a bailout. It's the kind of thing where it's an odyssey kind of situation, right? You really want to tie your hands somewhat and not say we're constantly going to be going to systemic risk exception and have that hardwired in. What you'd really rather have is a higher bar. And I think one of the things that gets lost in this discussion is that if we take a step back, the optimal number of failures, I agree with Bill that there are going to be these failures, but the optimal and need for rescue, but the optimal number shouldn't be zero. We shouldn't be bailing out every single one of these financial institutions. At some point, the systemic risk determination becomes less credible, more implausible. And so I think we should just keep that in mind as the expansion of what we call systemic risk continues. I'm not persuaded at all that there were the same kinds of system-wide risks posed by these three financial institutions that there were in 2008. I know that's a controversial point, but we aren't willing to run the experiment of watching what a financial institution failing would do. I think that's a big difference from 15 years ago.
Could I just jump in quickly to picking up on what Frank said? I mean, there's been no consequences for poor risk management and poor risk decision making. If you just look at Silicon Valley Bank again, because the FDIC decided to bail out all the depositors, not just those who had $250,000 or less in their accounts. Why should Andreessen Horowitz, which is one of the most sophisticated financial institutions on the planet, put $1 billion into Silicon Valley Bank in terms of depositing their money, their payroll, whatever it is, their portfolio company's money? Why should they suffer no consequences for failing to appreciate what was going on with this short-term borrowing and long-term lending? Borrowing short, lending long, the classic problem of fractional banking that has been with us forever, because Andreessen Horowitz and their like don't have faced the consequences of that failure to understand, appreciate that risk. Then it's like child behavior. If you don't punish a child or reprimand a child for their bad behavior, they're going to repeat it. And so without any consequences, obviously you don't want to have consequences for small depositors. That's why there's FDIC insurance. But for big, sophisticated depositors to get off scot-free without any penalty whatsoever, you're asking for a repetition of the bad behavior over and over again, especially in a system, as we've discussed earlier, that is designed to fail, once every 15 or 20 years.
Well, not only are you, incentivizing them to do that, but you're incentivizing them to do exactly what they did during SVB, which was to, basically force the government's hand by going on social media, and talking about, Jason Calacanis saying, your hair should be on fire, and Bill Ackman saying if the government didn't, insure all deposits, there would be a giant sucking sound of, a historic bank run. And, it worked. It basically caused a mass cascade. I guess I know we're going to have a panel later on too big to fail, but I am curious from your point of view, and we've talked about this a little bit about systemic risk, but what does too big to fail even mean now when you've got high frequency trading, social media, just the destabilizing impact of being able to withdraw your money in a nanosecond? I mean, do we need to rethink what systemic risk even is, especially as the FSOC embarks on another go round at looking at how to designate systemically important financial institutions, the non-banks? I guess I'm curious. It just seems to me like what we thought of as systemic risk for so long, to Frank's point, doesn't really apply anymore. So how do you deal with a system in which you basically are, chasing your own tail?
I'm just going to quickly make a point and then be quiet. But risk doesn't disappear just because a regulator moves it out of the Wall Street banks, which is what happened with Dodd-Frank. Basically, Wall Street went from being in the storage business to the moving business, right? They have to get these loans and assets off their balance sheets as quickly as possible, although they haven't done that yet with the Twitter loans, which is a whole nother topic. But they are forced to do that, okay, theoretically by the Fed, by their regulators. And maybe they've done that to some extent, but probably not as much as they should or need to. But that doesn't mean the risk disappears. Risk is out there everywhere. And so, the question is, where does it go? It goes into the shadow banking system that exists. It goes into collateralized loan obligations. It goes into leverage loans that are held by investors all around the world. And so may have moved through Dodd-Frank the risk out of the left ventricle of capitalism, the Wall Street banks, and they're probably safer than they've ever been. But that doesn't mean the risk just disappears. It just moves around, and therefore we're asking for the next financial crisis to be originating in a place that we least suspected at the moment.
Jennifer?
Yeah, so it's interesting when you talk about too big to fail. I think many of us associate it with the 2008 financial crisis, but actually it dates back to 1984 with Charlie Knapp, who was the head of American Savings and Loan, which I believe had a balance sheet of only, it was remarkable growth, but I think his balance sheet was only $34 billion. And when he testified before Congress, he had a meeting with the regulators. It was a savings and loan in June of 1984. And he said, we're too big to fail. If we go down, we'll take the whole system with us. And they ended up arranging for a bailout of the bank. People think it was associated with Continental Illinois. It was actually this. But the point is, this idea of too big to fail, it was much smaller, $34 billion, very different than a multi-trillion-dollar balance sheet. So I think the problem with the phrase now is we think it's all about size and you have to be ginormous. And I think it has a lot more to do with how the balance sheets are managed and how the maturity mismatch is done. And I'll just say, we could be doing things differently. In the world I came from, money market mutual funds, they have a very tight maturity mismatch requirement, how long the assets can be because of the very short-term liabilities, the daily weighted average maturity. It's an idea, to say that, to look at the composition of a bank's liabilities as compared to its assets and look more closely at the nature of and the liquidity of those assets. And particularly, we've talked about the trigger of rising interest rates being what led to the run and the collapse of Silicon Valley Bank. Same story pre-2008, same story with the S&Ls. It's not that the folks who run these places don't know. Well, some of them don't know and don't care. Others do know, and it's the IBG, YBG. I'll be gone, you'll be gone. They still, their checks still clear. Their second wives still have, the fur coats. The golf course still lets them play. It's a way of the world now, and I don't want to accept it. I want to shine a light on it, but there we are.
Frank, you have some thoughts on this?
Yes, I completely agree about shining the light. One of the interesting questions about SVB was who was there to even shine the light, because I didn't have a chief risk officer for 8 months. But in terms of shining light within institutions, one of the things that we know is that with respect to this yield curve carry trade that Bill is talking about, if they don't do it, they're not going to make any money. So they're going to be taking on risk of some kind. The question is, let's get disclosure about it. And one of the issues, again, looking back to Lehman and what banks were doing then, was essentially, yes, offloading risk, but offloading it by tossing a boomerang. And the boomerang comes back. And one of the questions that we don't know the answer to right now is the extent to which large institutions are tossing a boomerang, that they appear in some ways to have offloaded risks. But remember that large institutions have over $1 trillion worth of variable interest entities, the same kind of technology that Enron used to move its risks off balance sheet. They have lots and lots of derivatives and swaps still. And we don't have an accurate sense of what mark to market is on many of the loans and other assets that have obviously lost a lot of value post-COVID. So I think shining that light is really important, but we don't do that. And again, we don't have incentives for people outside of the institutions to spend a lot of time looking at that. Short sellers aren't spending a lot of time on this. Investigative journalists aren't really incentivized anymore. And Deborah, you've done so much fantastic work, but how many of your colleagues are now working, spending 2 years working on an expose about the footnotes of a bank's financial statements?
We actually had a question from
the Goldman case of the Supreme Court, so it's really hard for people to shine the light. I think Jennifer's right.
We had a question actually from somebody who's watching who wanted you, Frank, to expand on that a little bit. Like, why are short sellers and activist investors not doing their due diligence? Put aside journalists, that I'm happy to talk about what I think, or if you can, but I do find it weird. Like, that is your job, to understand risk and where you want to bet against, if not invest in, right?
Well, short sellers are being threatened with prosecution from the Department of Justice. They're facing very high transaction costs in terms of lending. They're being attacked on Reddit in lots of instances when they do take short positions. The bar to short selling making money has gotten higher as the costs associated with borrowing shares has increased. So there are lots of barriers to short sellers. The plaintiffs' lawyers make money some of the time, but they also spend 15 years since Lehman working on cases like the case against Goldman Sachs that was appealed, went to the Supreme Court and is now not certified as a class. So the incentives for the production of this information aren't there in the same ways. Activists have been very effective in many other industries, but when they look at banks, it's hard to justify taking on a large position as a shareholder activist to try to get inside the details and get things to change. And as a result, I think this is one industry that's been at least somewhat protected from shareholder activism. So it's lots of kind of institutional costs that put up barriers to these various actors who might generate information being successful and making money off of generating that kind of information.
It's really fascinating. I wish we could spend more time on that. We're running out of time, and I want to talk about the Consumer Financial Protection Bureau. And I know Jeremy likely has a lot of thoughts about this. I mean, when you think about this agency, it has been under attack from day one, and those attacks seem to be succeeding. We saw this week a conservative judge in Texas basically said that they overstepped their authority when they tried to get implement some anti-discrimination policies. And we've got, obviously, as you mentioned, this big case coming up before the Supreme Court that could essentially hobble the agency if, by limiting the power of independent agencies. Jeremy, what is going to be the impact or the ramifications of all of these challenges against an agency that was set up to basically protect consumers from, bad actors, right? I mean,
yeah. So I'm really worried about this, Deborah, because it is a radical legal challenge on a completely novel legal theory dealing with the CFPB's funding. The CFPB, of course, derives its funding from the Federal Reserve Board in exactly the same way that the Federal Reserve banks derive their funding from the Federal Reserve Board. So the consequences of this case is, if it comes out, as I fear it might, against the CFPB, could have very far-reaching consequences, not just for consumer finance regulation, throwing into question all of the mortgage market regulations, credit card protections, debit card protections the CFPB has passed. They could really adversely affect not just consumers, but the financial institutions that rely on those regulations. Some of the CFPB's regulations are safe harbors that many financial institutions rely on when they engage in certain types of consumer finance transactions that financial institutions may pull back from if they no longer have those that legal certainty of a CFPB passed safe harbor. So there could be wide-ranging consequences for consumers, wide-ranging consequences for financial institutions. I worry about the broader financial stability impacts if the CFPB's work is undermined by the Supreme Court. And we got to worry about the knock-on consequences of what other agencies may come under fire. As I mentioned, the Federal Reserve is funded similarly to the CFPB. The other financial regulators, FDIC, OCC, are funded by assessments levied on the institutions they regulate. Those could similarly come under question. So unfortunately, a lot of incoming fire coming at not only the CFPB, but the other financial agencies, all on these administrative law technicalities, not dealing with the substance of what they were doing, but on their governing statutes that I fear for the wide-ranging implications that of what might be coming if the Supreme Court doesn't craft its ruling very, very carefully.
Yeah, I mean, I don't know if others have thoughts on that. But the court challenges and the use of the courts is really interesting, especially given what we're seeing now as the banks clearly are gearing up, not just the banks, but other trade groups are gearing up to sue the Fed over the Basel Endgame rules. I mean, they sent a letter yesterday that made clear they're going to, use the the APA basically to say that the Fed is overstepping and didn't actually give enough notice and comment. I mean, I guess, Bill, I'm curious from your point of view. I thought banks liked certainty. Why do they keep trying to take, to undo some of the things that have been in place for a while? I mean, the Basel Endgame stuff, obviously, I understand that they're very concerned about that. But the things like the CFPB, to Jeremy's point, I mean, there are safe harbors in there that they've made loans, using. And if the Supreme Court does rule against them, it could question the legitimacy of a lot of the rules that they've put in place over the past, 10 years since they've been, legislating or regulating. I'm curious, I don't know if you talk to folks, you seem to have a good insight into the banks and what they think about. I mean, what is their view of the CFPB at this point, and why do they want to kind of make it, obsolete?
Does the word hate mean anything to you? I mean, they hate the they say they hate it. They've hated it from the beginning. They fought against it. They don't like the Dodd-Frank regulations. They fought against them. I mean, Goldman Sachs used to have 70% return on equity back in the days when it was unregulated private partnership. They had very little capital. Sure, that made them very risky, but it made them risky to their partners and their shareholders. Now, of course, big public company, $100 billion market cap. I'm sure they believe they are required to have way more capital than they really need. Their return on equity is quite low now. It's not anything like what it used to be. They struggle to get a return on equity up in the teens. And I'm sure they dislike it. They don't want to have more capital tied up. They want to be able to, they were, expert, as I wrote in my Goldman book, that they alone saw trouble coming in 2007 and 2008 and did something about it, made huge bets against the mortgage market and made huge profits when the rest of Wall Street was losing money hand over fist, may even have exacerbated some of those losses that their competitors faced. They don't like regulation. They want to go back to a time where they could make big bets on interest rates or mortgage rates or whatever it is. And, so they're going to fight against it as best as they can.
Jennifer, Frank, do you have any thoughts or concerns about what's happening with the CFPB before we have to close?
I would concur with what Bill said. They haven't liked it. They didn't, their lawyers didn't put it in the legislation, and they will, it's worth it for them to continue to fight.
I think it's an illustration of how hate is just not productive, that we've become so polarized in so many ways. And I'll just again say thanks to Better Markets for having a conversation like this, which I hope doesn't involve a lot of hate. We can say nice things about each other and try to have a productive conversation moving forward. I wish people would do that with respect to that organization.
Well, thank you to everybody for this. I wish we had another hour, and I'm sorry that I didn't get to more of the audience questions. Just want to let everybody know that there will now be a 30-minute lunch break before the afternoon sessions, which will start with a fireside chat with the SEC Chair, Gary Gensler, which I'm sure will be fascinating. And I want to thank you all for a lively panel in which we talked about both Oliver Wendell Holmes and succession, which you don't normally get in a panel about financial regulation. So thank you, and I hope you guys enjoy the rest of the conference.
Thank you, Deborah.